Hello everyone, welcome to my YouTube channel. In today's video, I'm going to discuss the swing trading strategy using exponential moving average and volume simple moving average. I'm giving the strategy name as GVK EMA VMA crossover for future references. This is not my strategy. Actually, randomly I got some video in my timeline and I watched this strategy and it was interesting to me. Then I asked the owner of this channel to backtest over a longer period of time frame. Then I took a consent and started backtesting it. I'm going to present different variations of this strategy and their results in this video. Let's discuss the strategy rules. Either you can go with Nifty 50 stocks or Nifty next 50 stocks. The time frame is daily. We need to buy if any of the below two conditions meet. So the first condition, 4 EMA crossover 7 EMA on the candlestick chart and 3 volume simple moving average is greater than 50 volume simple moving average. We'll go and buy when this condition satisfies, or when 4 EMA is greater than 7 EMA on candlestick chart and 3 volume SMA crosses over 50 volume simple moving average on volume chart. Either of these conditions meet, we are going to buy the stock. Stop loss. There is no stop loss in this strategy. Target is 30%. How to allocate the trading capital for each stock? Let's say if you are trading in Nifty 50 or Nifty next 50 and your capital is 10 lakh, then we allocate the equal amount for each stock, that is 20,000 in this case. Coming to backtest variations, I have performed in this video. In the first variation, it's same as it's mentioned in the GVK's video. The time period for backtest was considered was from 2019 November 22nd to 2024 November 19, which is almost 5 years. In this scenario, the stocks considered are latest index stocks. That means what are the Nifty 50 stocks as on today 2024 November, the same list of stocks considered for the entire backtest period of 5 years. Okay. In the second variation, I'm going to do a little bit modification from variation 1. In variation 1, the backtest does not exit the open trades for which the target is not hit yet. That means there are still some open positions which are in either profit or loss. But in the second variation, I will exit all the open trades on the last date of backtest period. Okay. Then look at the variation 3. The variation 3, 4, 5, 6 all are based on some logic that I provide in the middle box in the center. This is same as variation 2. The time period is same and we exit all the open trades on the last date of backtest period using Nifty 50 stocks or Nifty next 50 stocks. But here we are going to use the survivorship bias free data of index data. That means we are not going to consider the latest index list as in 2024. Instead, throughout the backtest period from 2019 to 2024, whenever there were changes in the Nifty 50 index, we are going to consider only that particular list as on the date when the backtest was getting performed. That means this will provide the actual result of the strategy in a real world. And in variation 3, we will consider exiting a trade when a stock is excluded from the index. Okay. During the backtest period from 2019 to 2024, there are many stocks getting added to the index and of course getting removed from the index. So what should we do when a stock is excluded from the index? Because we don't have any stop loss in this strategy, either we exit the stock when it is excluded from the index or we can just continue holding it until it hits target. Okay. So variation 3 considers exiting the trade when a stock is excluded from the index, and variation 4, we are not going to exit the trade when excluded from the index. We'll just continue holding till it hits target or till the end of the backtest period. Okay. Then comes the variation 5 and 6. We'll extend the backtest for 17 years, that is from 2008 to 2024. We exit the trade whenever it is excluded from the index. And in variation 6, same as variation 5, but we do not exit the trade whenever the stock is excluded from the index. Let's backtest all these variations. Look at here, the time period selected here 2019 November 22nd to 2024 November 19. Here, what I'm doing is use latest index list as on today, true. Okay. And exit open rates at the end, false. So in the first variation, we are not exiting the open trades in this backtest. Let me run the backtest. Yes, look at the result here. The net PNL is 10 lakh, which is approximately 100% return over the 5 years. This is without compounding. That means we got absolute return of 100% in the last 5 years when we tested this strategy on Nifty 50. Okay. If we consider the compounding part, we would be getting around 19.79% CAGR. Like this. If you compound it, the 10 lakh will become 11 lakh 52,000 at the end of 1 year, then 15 lakh at the end of second year, likewise. So it will be resulting to 24 lakh at the end of 5 years. That comes to a CAGR of 19.79. Okay. Let's backtest this on Nifty next 50. Yes, in this case, the absolute returns of this strategy when performed on Nifty next 50 is around 138% over the last 5 years from 2019 to 2024. And when you compound this, the CAGR coming as 22.43% for Nifty next 50. Okay. This is variation 1. In variation 2, we are going to exit all the stock at end of the backtest period, whichever the trades are open and did not hit the target. So I'm making this true. Here as well, we are going to use the same list of stocks as on today, that is latest index list. True. Okay. Now let's see. Let's backtest for Nifty 50 first. Yes. So we got the return of 95% instead of 100% from the earlier backtest. And the CAGR is coming as 18.84%. Okay. Let's again do the backtest on Nifty next 50. Nifty next 50 gives 126% absolute returns over the 5 years. And if you consider the compounding, it will be 20.52%. So in the earlier backtest, where we did not consider exiting the open trades at the end of the backtest, we got around 138%. That is reduced to 126%. That means whichever the trades we exited at the end of the backtested period were actually in loss. That's the reason the percentage of returns got reduced from the variation 1 to variation 2. Okay. Now, coming to the variation 3. In variation 3, the main important factor is we are not going to consider the latest index list for the last 5 years. Instead, we use the index list corresponding to the backtest month. Let me make this as false. We are not going to use the latest index. And at index adjustment, I'm making this true. And exit on exclusion, I'm making this also true in variation 3. So whenever a stock is excluded from the index, we are going to exit the trade at whatever the price we have. It may be in loss or it may be in profit. We don't wait for the target to hit for the trade. Let me change the index to Nifty 50 and backtest this. Yes. So the Nifty 50, when we consider the index adjustment instead of the latest index list, we got 76% absolute return instead of, I think 96% was there previous backtest. Now it got reduced to 76%. And when you consider the CAGR, it has come down to 14.99%, whereas in previous version, it was around 18 plus. Okay. So this is actually real backtesting when we consider the index changes. Now, let me do this on the Nifty next 50. The same backtest of variation 3. Yes, Nifty next 50 gave even very less returns compared to Nifty 50 in this case. This is just 68% absolute returns over the 5 years, and if you compound it, it will be around 10.97 CAGR. Okay. Then we need to backtest the variation 4. In variation 4, what we are doing is we are not going to exit a trade, that means any open trade, when a stock is excluded from the index. We just keep the trade open until it hits target, or till the end of the backtest period. We'll just hold it and we exit on end of the backtest period. Okay. Let me backtest the variation 4 with Nifty 50 first. Yes. So in this case, when you don't exit a trade when it is removed from the index, we got around 78% absolute returns compared to variation 3, where it was 76%. And the CAGR about 15.4% when you compound it. Let me check the same thing for Nifty next 50. This is variation 4 only. Yes, Nifty next 50 performed better than Nifty 50 when you just hold on to the stocks even though it was removed from the index. So in this case, Nifty next 50 provided 103% returns. This is absolute return, and if you consider compounding, it is 16.67% CAGR over the period of 5 years. That is 2019 to 2024 November. Okay, then let's backtest the variation 5. Let me go back to Nifty 50 again. Okay, and exit on exclusion. Exit the trade on exclusion from the index. It's true. And the backtest period is going to change from 2019 to 2008. So that is for last 17 years, we are going to backtest this now. Okay. Yes. See, look at the result. Now the absolute returns, when you perform this over the last 17 years, it's just 134% over 17 years, which is very less. And if you compound it, that is coming around 7.75% CAGR, which is less than the index returns. Okay. Let me just do backtest of the same on Nifty next 50. Yeah, Nifty next 50 is comparatively better than Nifty 50, which is 156% absolute returns over the last 17 years, and with compounding it is coming around 8.86% CAGR. Okay, let's backtest the variation 6, where you don't exit the trade when it is excluded from the index. Okay, let me do it for Nifty 50 first. This is variation 6. Yeah, absolute return of 168% over the last 17 years on Nifty 50, and the CAGR coming as 9.68%, which is again less than the index returns. Sorry, there's a correction. I think index has given around 8.8% returns from 2008 to till date, whereas this strategy provided 9.68% when you don't exit trade when it is excluded from the index. This is as per the variation 6 logic. Okay. So that means here it's beaten the index by 1% approximately. Let me just do the same thing on Nifty next 50. This gave a return of 14.57% over the last 17 years on Nifty next 50. Let me show you the report of Nifty 50 when we backtested from 2008 to 2024. In this case, we are not going to exit a trade when it was excluded from the index. So generally, what will happen to those trades, correct? So we have to keep on holding right from 2008 or 2009, whichever period the trade initiated, and it never hits its target of 30%, then we just keep on holding those trades in our portfolio till 2024. What would happen to them and what kind of stocks they are? Let's just check them. Okay. The exit reason, basically there are two variations here. So one is it was excluded somewhere in between from the index and we just continue holding it. Somewhere some stocks target hit despite they were excluded from the index, and some trades did not hit target and they are there in the portfolio till the end of the backtest period, that is till 2024. Let me just filter those trades here. Yes, see. So there are trades like here Tata Power, G Glaxo, which was there in 2008 but excluded in between from index. They hit target of 30%. See, look at the Tata Power. In 2008 January 3rd it entered. It never hit its target of 30%, but after maybe 12 years it got target hit 2021 here. Okay, and some trades target hit after 2 to 3 years like this. Okay, let's see what are the trades that didn't hit target even as on 2024. Okay, let me filter that. Yeah, we exited all these trades at the end of the backtest period only. They never hit their target. Unitech, see Unitech initiated in 2008, even 2024 it didn't hit target. The entry was around 538 and the current price is just 9 rupees. That means 98% loss. And there is Arcom, initiated again in 2008, never hit target. We entered at 790. Now the exit is 0.75, 99.91% loss, which is 100% loss. So all this like Sujlan 87% loss. As we entered at 454, now it's 56. So SAIL, BHL, R Power, Satyam Computers. Of course, Satyam Computers might have exited in between only because it was got delisted. So we don't have data after 2013. So this was 2013 was considered the end of the backtest period for this. Okay, in this case 518 entry and 115 was exit. Okay, yeah, maybe I don't remember exactly whether it was because of this 115 because of delisting or because of amalgamation with another company. But anyhow, as per the data, this was the last price. So I just consider this price as the exit price in our backtest. Okay, that was 77.8% loss. Reliance Capital and Reliance JP Associates, Ster, PNB, Sesago, Kane. There are so many stocks never hit target. Okay, many stocks are actually quite older. Only the old people might be knowing who were there in the stock market for many last 20 years or more. But you guys may be knowing, right? This one, India Bulls Housing Finance and his bank. Okay, these were the stocks that never get target of 30%, and we exit lost at the end of the backtest period. We exited 93% loss for S Bank. Okay, now let's just look all the results in a format of table. Yeah, these are the backtest results. Here you see a table with different columns. First is backtest, variation 1, 2, 3, and then survivorship bias free, yes or no. Whether we are considering the latest index list or we are considering the corresponding Nifty 50 stocks list during the backtest period. Exit on excluding from index. Whenever the stock is excluded from the index, should we exit, yes or no? Okay. Then number of years, then Nifty 50, Nifty Next 50, absolute returns, and CAGR, and Nifty Next 50 CAGR. So in variation 1, is it survivorship bias free? No, because we are considering the latest index, 5 years time period, 2019 to 2024. We got 100% absolute returns in Nifty 50, 138% Nifty Next 50, 19% CAGR, Nifty 50 and Nifty Next 50, 22% CAGR. In variation 2, where we exit the stocks at the end of the backtest period, exit the open trades. Okay, in this case, the absolute returns of Nifty 50, 95% and 126% on Nifty Next 50. CAGR is 18 and then 20. Variation 3, here we are going to change our methodology to have a survivorship bias free data instead of considering the latest index stocks list. Okay, and variation 3, we consider exit on excluding from index. Whenever a stock is excluded from index, we are going to exit that particular trade from our portfolio. In that case, see the result is 14.99% CAGR on Nifty 50 and 10.97% CAGR on Nifty Next 50 over the last 5 years period. And variation 4, what if you don't exit a trade when it was excluded from the index? The result look like this, 15.4% CAGR and 16.67 respectively. Then variation 5 comes. This is the backtest period of 17 years. Okay, and we consider exit on excluding from index true. it gave absolute of 134% over the period of 17 years. Then Nifty 50 gave just 7.75% CAGR and Nifty Next 50 gave 8.86%, which is less than the index returns. And variation 6, where we consider we don't exit a trade when it was excluded from the index. Again, for the same 17 years, we got Nifty 50 CAGR of 9.68% and Nifty Next 50 CAGR of 14.57%. Okay, I hope you got a clear picture. When we consider the latest index or when we consider the proper list of Nifty 50 or Nifty Next 50 stocks during the backtest period. And when you look at 5 years period, it looks to be working fine. More or less same as index returns or a little bit more than index returns. But when you backtest it for a longer period, then you see a different picture altogether. Okay. So what's your take from this? Beating index is not easy in the longer run when you trade the stocks from the same index. Okay. In short term of 1 to 3 years, you may win over the index. Okay. But whatever the strategy, whether you or I or anybody create and think that it's working in the recent times, that doesn't mean it will work in future, right? Because the strategy that you're going to backtest or you're going to analyze should be tested against different market cycles, not just a bull market or any bear market. Okay. So if you consider 2008 to 2024, this is a really good period because we had a really great bear market crash of 2020 and a period of 2015 to 2018 approximately. The index was moving nowhere, like consolidation with a very less returns, and the period from 2020 till 2024, it's a great bull run. So this backtest period actually covers many different cycles of the market. So if something works during this period or the long period, that you may assume that will work in the future as well. Okay. Another point I just want to add, when you just consider the Nifty 50 or Nifty Next 50 index based stocks and beating the index over a long period of time is very difficult. Generally, if you really want to beat the index, you should have your own list of stocks. Let's say you prepare some quality list of stocks on your own that generally do not exclude from the index because of some very bad reasons like frauds, etc. If you can consider those kind of quality stocks and try trading this strategy or any good strategy like this, generally it may work. Okay. Another thing, whether you use 5 EMA, 7 EMA, 50 EMA, 200 EMA, doesn't matter. All these kind of strategies, when you backtest over the period of 10 plus years, they give generally similar kind of results as I have shown in this video. Okay. That's it, guys. Thank you very much. Bye.